Hello, and welcome to United Asset Strategies' fourth quarter investment call. I'm Tom Healy. Joining me today are Matt DeLorenzo and Jiorden Sanchez. Wow, what a difference a year makes. Last year at this time, we were reviewing 2022, which was a down year, double-digit declines in both stocks and bonds. 12 months later, we're going to review 2023, where we saw strong results on the equity side, particularly from growth stocks, and also a fourth quarter rally in the bond market, leading to solid overall returns for the bond market as well. First, I'm going to shoot it over to Jiorden to get into more detail on what we saw last year.
Sure. Thanks, Tom. So to Tom's point, markets were strong in 2023, recapturing most, if not all, of the value they lost the year prior. And you can see that on the left side of Exhibit 1, where we highlight how strong double-digit stock market returns in 2023, more than made up for their losses in 2022. And, while bonds have not yet fully recovered their losses from 2022, they did generate a very respectable mid-single-digit return this year, which is all really solid. Worth noting, and is highlighted on the right side of the exhibit, for most of the market, those healthy full-year returns were largely generated in the fourth quarter. So in our last video, we highlighted that the 7 largest tech stocks, in other words, the Magnificent Seven, drove most of the year-to-date returns through the third quarter, with the average stock and bond market roughly flat. Fast forward to the fourth quarter, and we saw market participation broaden out. The typical stock, as measured by the S&P 500 equal weight, generated double-digit percent returns, and the bond market generated about high single-digit percent returns. So all of this was really consistent with some of our comments last quarter, where we noted the potential for seasonal market strength and into year-end, and coming off of attractive valuations for most of the market if you excluded the Magnificent Seven. Now, we believe that broad market strength was driven in part by the growing possibility of a soft landing, in which inflation moderates to the Fed's target and the economy retains full employment and avoids a recession. So in our last video, we pointed to moderating inflation, upside economic surprises that we had seen through the third quarter, and that strength continued in the fourth quarter and beyond. Just this morning, we saw GDP growth come in over 3%. That compares to street expectations for 2%. So now moving over really quickly to Exhibit 2, this persistent strength drove the Fed to positively revise its economic outlook throughout the year for both GDP growth and the employment rate. And this eventually led to a dovish pivot in the December meeting, where they lowered their forecasts for both inflation and the Fed funds rate. So to get into a bit more detail on the Fed pivot and monetary policy, I'll take this moment to turn it back over to Matt.
All right. Thank you, Jiorden. What's interesting here is that normally when we think about the Fed cutting interest rates, it's amidst a deteriorating economy and typically weak financial markets, stocks and bonds going down. And in this situation, the situation the Fed is really laying out here is that they're potentially going to be cutting rates this year into economic strength. So what's really going on is they're attempting to manage the level of restrictive policy. So one way to think about it is right now, the level of the Fed funds rate is more than 2% higher than the underlying inflation rate that we've recently seen. So that's one way to measure the real yield, as it's called, or another measure of restrictive monetary policy. How tight monetary policy really is can be looked at as checking on how high the real yield is. So given the same Fed funds rate, if inflation continues to come lower, then that difference is going to be wider. So the real yield will be higher and the level of monetary tightness is actually going to go up. So if this plays out as the Fed is laying out, that inflation continues to come lower, the Fed will actually be able to lower rates and really keep the same exact stance of monetary policy, the same sort of real yield. And as the years go on, if inflation does dissipate, as the Fed hopes and the market hopes, that amount of real yield, that amount of restrictive monetary policies can come even lower. And that would give the Fed even more room to cut rates over the long run. So with that, enough about monetary policy. Obviously, this year, politics is going to be another big component for markets. So I'll turn it over to Tom to discuss.
Okay, thanks, Matt. As Matt mentioned, after the Iowa caucuses in recent weeks, it's formally kicked off the election season here in the U.S. But geopolitical risk is something we are watching. We have a war in Ukraine, an ongoing war in Gaza, neither of which look like they're coming to a conclusion anytime soon. In addition, you have rebels attacking shipping lanes out in the Suez, which is creating the potential for price spikes and supply chain disruptions. So we're watching that very closely. As for the U.S. election, um, one of the things that we'd make most important is that how does it impact markets? And as you can see here in Exhibit 3, that over a presidential cycle, these are the 4 years of presidents in office. The fourth year, which is this year, tends to be pretty strong. On average, it's up 16%. Not ironically, last year, which is the third year, historically has been up 24%, which is basically exactly where the S&P was up last year. So, and about 100% of the time, we see those strong results. They tend to start out slowly, but as the year progresses, we see strength. And a lot of that is due to the fact that in an election year, both parties want to show some fiscal stimulus. And so, right on cue, we're seeing the discussions in Congress about a tax law bill to cut taxes, particularly on the corporate side, but also some additional stimulus for the consumer. And a lot of that has to do with the fact that we're in a political year. So, we do expect policy to be a tailwind for markets. And as you can see on the right side of the exhibit, no matter what the outcome is, typically markets remain solid throughout, no matter how we have it constructed. In other words, the president, the House, and the Senate, whether they're Republican or Democrat or split, we tend to have strong markets. So while we're not discounting the importance of the election, nonetheless, there's a lot of other factors that we think are more important in determining the outlook for markets. But we will be watching this very closely as the year progresses. And so this kind of ends the sort of macro discussion. Now, to get more granular on markets, I'm going to turn it back to Matt to discuss fixed income.
All right. Thank you, Tom. So first, just a few key observations about, how things sit following the big rally we had in Q4. And if I can turn your attention to the left of this slide, you can see the expectations from the Fed and the market really of where Fed funds rate will be at the end of 2024. So as we mentioned earlier, the Fed funds rate is higher right now, and the Fed actually anticipates cutting rates as the year goes on. You could see that in the yellow bar right there. The green is actually the market's expectation as derived from Fed funds futures. So you can see that the market is actually quite a bit ahead of the Fed in that they're anticipating an additional 3 cuts further than the Fed's anticipation to bring Fed funds rate all the way down, potentially below 4%. So that kind of shows you there's quite a bit of optimism around these Fed cuts. We definitely think that the strong economy is a good thing. The inflation dissipating is a good thing. But there's definitely a chance that the market is potentially a little bit ahead of the Fed. And you really can see it right there. But as far as how that translated into the performance, obviously it was one of the big drivers for the rally that we saw in Q4. So we saw rates come down and we saw credit spreads tighten. So if you look at the chart on the right, that is basically a way to show the incremental yield that you obtain on a corporate bond as opposed to just buying a treasury. So when it's higher, that shows a little bit more fear. When it's lower, it's really more complacency, and you're getting less extra compensation for taking on credit risk. The example we showed in the letter, which takes into account both interest rates coming down and credit spreads tightening, is simply a 10-year Apple bond. Entering the fourth quarter, an investor was able to buy this high-quality corporate bond at a yield to maturity of 5.3%. Given how much everything rallied, entering this year, the yield on the same exact bond is down to 4.1%. So things have rallied quite a bit, and a lot of this has to do with the additional optimism about the extent of rate cuts we'll see from the Fed. Considering these things, towards the end of Q4, we took the opportunity to trim some of our longer-term positions. We trimmed the high-yield position into strength as well as a longer-term treasury, reinvesting the proceeds in short-term floating rate treasuries. In addition to being high income generators right now, because Fed funds rate remains high, they're also extremely liquid. So in the event that the market comes a little bit closer to the Fed as far as expectations for cuts, that has a potential to increase interest rates and widen credit spreads. We'd see that as a good time to sell some of the treasury floaters and reinvest a little bit more opportunistically. So, as you can see, we've been active on the bond side and optimistic about opportunities for the year ahead. But now I'd like to turn it back to Jiorden for an opportunity to update us on the equity side of things.
So thanks, Matt. As with bonds, I would add that the equity market is not as cheap as it was exiting the third quarter. Last quarter we did defend valuation, noting that excluding the Magnificent Seven, this typical stock traded at 14 times earnings, which is cheap historically. But following the broad market performance we saw in the fourth quarter, the typical stock now trades at 16 times. That's a bit more in line with the historical average. So in other words, investors don't appear to be assigning a discounted valuation to the average stock anymore, seemingly less concerned about earnings risk from a recession, and increasingly willing to underwrite that soft landing sort of scenario. Now, I'd point to Exhibit 5 really quickly. Here we provide an example of how we're actively managing around some of the macro and valuation related uncertainty we've talked about. On the left side, we highlight the strong relationship between the leading economic index and consensus earnings expectations. Further, the chart shows how parts of the market, like small and mid-cap stocks, or SMID, and cyclical sectors, are a bit more sensitive to the economy versus their large cap and defensive counterparts. On the right side, we show valuation multiples for these four subsets of the equity market. And despite similar sensitivities to the economy, cyclical stocks trade in line with the historical average, while mid-cap stocks trade at a steep discount. So relative to cyclicals, this suggests to us that mid-caps are pricing in a bit of a weaker economic outlook and potentially have less downside risk if a recession unfolds, but potentially more upside potential if a soft landing materializes. So now, while the chances of a soft landing have increased, and I think that's why the market has kind of rallied in the fourth quarter, it's important to know that it's still not a foregone conclusion, and there's still mixed signals out there. So one example would be the leading economic indicator, or the LEI. It usually leads the economy about 7 months or so, and it's negative on a year-over-year basis. This meets the Conference Board's definition of a recession signal, and it contradicts the more rosy outlook that the Fed has provided through its summary of economic projections. So while we do remain cautiously optimistic on the state of the economy, and we have maintained exposure to economically geared stocks, the way we are actively managing this uncertainty is we've done so through a tilt towards more attractively valued mid-cap stocks and away from more fairly valued cyclical stocks. So in closing, the trajectory of the economy and the markets remain very strong, but the future is always uncertain. And so we continue to manage client portfolios in a manner that would be resilient to a wide range of scenarios. And for 2024, we're continuing to focus on the pace and extent of rate cuts, the resiliency of the economy, the geopolitical calendar, and all of their market implications. And we'll continue to actively manage client portfolios accordingly as we get updates. So at this point, I'll just turn it over to Tom to close it out. Thanks.
Thank you, Jiorden. As you can see here, the investment team at United is parsing through a substantial amount of data in our efforts to manage your client portfolios. To that end, we're adding to staff. We're pleased to announce that we added Keith Douglas, a veteran of the bond markets, been in the industry for almost 30 years, most notably at Citigroup for almost half of that. He joined us in the last few weeks. and we're looking forward to his contributions to do even more on our fixed income side. With that, we're going to sign out. But if you have any questions on what you heard today or anything else for that matter, you can reach out to your relationship management team and they'll be glad to help. Otherwise, we'll see you again next quarter. Thank you.